Here we are picking up from Tuesday's class talking about payroll and payroll taxes payable. Payroll as a generic term is going to refer to both the salaries of your managerial, administrative, and sales personnel. Those are quoted on a monthly or yearly rate, something along the lines of $75,000 a year or $3,000 a month, along those lines. Wages, however, are those rates per hour that most people are familiar with. That's $20 an hour, $15 an hour. Regardless, either one is going to refer to payroll. There's a variety of things that we have to do with payroll and payroll taxes. We'll actually be going more in depth in this into the next class. However, it does involve computing three different significant amounts. The first is your gross earnings. Gross earnings are just that it is your hours times your rate. Um, Secondarily, we then have to determine what payroll deductions apply. Again, we'll talk more in depth about payroll deductions. This is the amount of taxes that are withheld from your paychecks or your benefits, such as your medical insurance premiums that are withheld from your paychecks and are remitted to somebody else. Much like sales tax, they are taken from you but paid for in your favor by your employer. And then net pay. Net pay is the amount that is on your check that you will be taking home. Now, if you happen to recall, earlier chapters, we talked about how salaries and wages payroll is adjusted at the end of the month. The last day of the month is not the payroll date. We will definitely go into more depth on payroll and payroll taxes in Appendix F. Primarily, though, the rest of these slides will actually be talking about bonds. Bonds are a form of interest-bearing notes payables that are issued by corporations, universities, and governmental agencies. The buyer of the bond, the person who actually purchased it, is called a bondholder. They are investing in bonds. You can invest in bonds like you do in stocks. There is an actual bond market. Companies usually sell or issue bonds in multiples of 1,000. And bonds are quoted when we're looking at purchasing one in a bond market as a percent of the 1,000. So if it is 100%, it is 1,000. If it is 98%, it's 980. So on and so forth. Your bonds payable account is going to represent your bond price times 1,000 times the number of bonds sold. When bonds mature, this is when they have reached their term, because remember, with a notes payable, there's a term attached to it. The buyer is going to get $1,000 times the number of bonds that they purchased. Starting with bonds, as I said, this is a kind of a sticky subject, and we'll be revisiting it again in class when we sit down together. There are secured bonds, unsecured bonds, convertible bonds, and callable bonds. So, talking about these different types of bonds. Secured bonds are secured by some type of a project. Unsecured is on the good faith of the corporation or the organization in which is issuing the bonds. A convertible bond is a bond that allows the bondholder to trade that bond in for a stated amount of stock. And a callable bond is a type of bond in which the corporation, after a specified period of time, can actually pay it off early, so they call it back in. Some of the terms and conditions that you're going to need to be aware of, especially for tests. Face value. This is the same as face value with a notes payable. It is the principal that will be due at maturity. Maturity date, same as with a notes payable. That is the date final payment is due. Contractual interest rate. This is a little bit different than just interest rate. The reason we use contractual interest rate versus just interest rate is that in the bond market, there's a lot of other types of interest that come into play. However, the contractual interest rate is the rate that we use to determine the amount of cash interest that gets paid on the bond. So a lot of bonds will actually pay interest at stated intervals, typically every 6 months or semi-annually. When you roll into the time for a bond interest payment, this is where this comes into play. This is stated as an APR though, so if it is semi-annually, you need to take into effect that it's only half. Bond certificate or bond paper is what is issued to the investor. It is actually a piece of paper that will provide the name of the company, the face value, the maturity date, and the contractual or stated interest rate. We're going to look at one of those here real quick. This is an example of a bond certificate from International Minerals and Chemical Corporation. It identifies it. You'll see that it says sinking fund debenture. Debenture is another word for bond. You'll notice that it talks about the interest rate. It just says it's 5.75%. Within this bond debenture will be all the terms that apply to it. It'll state how often interest is paid, what the general rates are, so on and so forth. Now we're going to real quick run through this bond terminology. You just got hit with a whole bunch of new words, but what I want you to keep in mind is that a lot of these definitions are actually very similar to those of notes payable. So let's start with the first one. Secured bonds have specific assets of the issuer pledged as collateral. As you will recall, we spoke about that here a couple slides ago, and that they are actually secured by a project or by something. So that is true. Callable bonds can be redeemed by the issuing company at a stated dollar amount prior to maturity. That also is true. The contractual interest rate is the rate investors demand for loaning funds. This is actually false. And the reason for that is that the contractual interest rate is set at the time the bonds are written. However, because there is an open market for it and things are constantly changing in our economy, the amount that an investor would demand would be different, potentially, from that of which is contractual. This comes into play in the bond market and whether or not a bond sells at a premium or a discount, which means that at a premium, it would sell at, say, 103%, whereas at a discount, it would only be at 98%. The face value is the amount of principal the issuing company must pay at the maturity date. This is true. This is absolutely true in the case of any types of notes payable or bonds payable, that the face value is the amount of principal that the company is going to have to pay out on the maturity date. This one's a little more tricky because we really haven't talked about it, but you would have seen something about it in your reading. The market price of a bond is equal to its maturity value. That is actually false. And the reason for that is because bonds are actually rated depending upon a credit organization rating. They also will change depending on what the contractual interest rate is versus the actual interest rate that is the current demand of the investors at the time of issuing. So the market price of a $1,000 bond could only be $980 if it's selling at 98%, which is a discount. We're actually going to skip this general section talking about determining the market price of bonds and move on to talk about how to account for various bond transactions. A corporation records their bond transactions when it actually issues or sells the bonds. It has a transaction it must record when it pays the interest on the bonds. It has to record when it retires, either buys back or pays back on the bonds, or when bonds convert from bonds into common stock. We're not really going to go into that particular section, but let's start and look at issuing. So your bonds can be issued at face value. That's 100%. That means that it has a face value of 1,000. It sells at 1,000. It can be issued at discount, which is less than 100%. Remember, several slides back we talked about 98%. Or it can be issued at a premium, which is more than 100%. That was when I said at 103%. This face value and how bonds are issued really depends whether it's a discount or premium on the factors of the interest that's tied to it. That's the contractual interest versus the current market interest. However, they're going to maintain that face value at any point in time. That means that $1,000 will be paid out at the end. How we arrive at that depends on whether they sell at discount or premium. Looking at issuing bonds at face value. We have Beaver Corp, who issues 5-year, 10%, $1,000 bonds dated January 1st, 2017 at 100%. So the information in here is that there are 100 of them. They're $1,000 bonds. They're issued at 100%, which means that the person who purchases it is paying the organization that issues it $1,000. So they are going to receive $1,000 in cash, 100% of face value. So they have a debit, an increase to their cash of $100,000. That is 100 times 1,000. At this time, they need to recognize that they have received cash and they now owe those bondholders. So they will credit bonds payable count $100,000. Now, in the course of a bond's life, you'll notice they gave us the interest rate. The bond is either going to accrue or pay interest, depending upon the terms of the debenture, the actual contract that's at play. Now, if the fiscal year ends on December 31st, it's going to need to accrue interest on those bonds. The journal entry to record that is 100,000 times 10% times the fractional year at play. In this case, it's 12 out of 12. So we have an interest expense for the organization of $10,000. And then we have interest payable of $10,000. When they go to pay that interest on January 1st, 2018, then the journal entry that would record that would be, we would reduce that interest payable because we are now fulfilling that specific obligation, $10,000. And our cash would reduce by $10,000 because we are paying out interest on our bonds. Now, I know that this is a lot of information, and we'll dig deeper when we get into class together. I want to give you kind of the broad overview right now. And let's talk about the prices of bonds. I've mentioned a few times, so have the slides. The bonds can be issued at face value, a premium, or a discount, regardless of which three they are issued at. When that bond matures, the bondholder will receive the face value. There are several things that impact the price of bonds: the bond market, the bond's credit rating, the issuing organization's credit rating, the contractual interest. So, this is what is actually written on the bond certificate, and the current interest rates. And we've had a little bit of a discussion throughout this entire term on how our interest rates are being manipulated by the Fed currently and have been for a long period of time. They're being kept pretty low. However, as those things change, like stock, the price of bonds can change in the market. Holders of bond can watch how the company is performing. If they are not happy with how the company is performing, the price of the bonds will decrease. If it's good, the price of the bonds will increase. This is because if a holder of a bond is not happy with an organization or how the company is performing, they may sell their bond, put it into the market to be sold. You'll learn in your basic economics classes that there's a supply and a demand that drives prices. That's how this works. And also, of course, bondholders are going to be watching the economy in the U.S., especially because we're talking about U.S. bonds in this class. If the economy grows, then interest rates are going to increase. Whereas if the economy is bad, it's retracting, then our interest rates will decrease. As I stated before, the current interest rate at any given point in time is going to impact the price of bonds that are issued when compared to its contractual interest rate. So we're going to first talk about when we issue bonds at a discount. On January 1st, 2017, Candlestick Incorporated sells 100 10% bonds at a price of 98%. Remember, they're quoted at a percentage of face value with interest payable on January 1st. This bond is selling at a discount because it's selling at less than 100%. The other thing to keep in mind is that bonds sell in intervals of 1,000. So if it is at 98% of an interval of 1,000, then we are only receiving $980 per bond. We have 100 bonds. That means that we will receive cash. We will debit or increase our cash for $98,000. We have an obligation to pay the full $100,000 face value of the bonds at maturity. That is written into the bond debenture, the bond certificate, that we will pay $1,000 at maturity, although we only received $98,000. We will use an account that is called the discount on bonds payable to enter the difference between the $98,000 and the $100,000 of total bonds payable that we are now obligated to pay. So we will debit a discount on bonds payable for $2,000 and credit our bonds payable for the full face value of the bonds of $100,000. The new bonds are selling for less than the final bonds payable amount. We debit the discount, which makes the current value of the liability less than the $100,000. I just want you to keep these particular transactions in mind And we'll discuss in a later time in your education and in this class how we deal with the discount on bonds payable as time goes on. Remember, we're recognizing the amount of the obligation at the current time. That's why it is netting out at $98,000. But we need to be aware and report for transparency purposes that $100,000 will pay out when these bonds mature. To show you how this is represented on the statements, let's take a look at this slide. So here we have Candlestick Incorporated's balance sheet. They have their long-term liability section because these bonds are being held for greater than a year. Means that at some point in more than a year, there will be $100,000 worth of bonds payable that will need to be paid at face value. We then have the separate account, less the discount on bonds payable for $2,000. That means at this exact point in time, our current obligation is $98,000. That is what we received. Flip side of that is when we actually sell a bond for more than its face value. So let's assume that instead, on January 1st, 2017, Candlestick Incorporated sells 100 10% bonds at a price of 102% with interest payable on January 1st. These bonds are selling at a premium. They sell for more than the final bonds payable. So with that, we take the amount of them. There's 100 bonds times $1,000 times 1.02, 102%. That gives us $102,000 in cash received. We will only be paying at maturity $100,000 out because we have to pay out the face value. So our bonds payable account is $100,000. We will credit to an account called premium on bonds payable $2,000. This is going to show the current value of the liability being more than the final $100,000. This slide's going to show us the general representation of how that would look on the balance sheet. Now the second part of bonds, bond interest, when we accrue it or have to pay it. So let's look at bond interest and accounting for that. Interest on bonds is stated in the bond debenture. It's going to state how often it's paid, what the APR is. So we use the same basic interest calculation. It's face value times your interest rate percentage times your fractional year. So Candlestick is paying 10% on the bonds each January 1st. Its fiscal year ends on December 31st. So they're going to always have to accrue it on December 31st. On December 31st, they're going to show an interest expense equal to $10,000 and an interest payable of $10,000. On January 1st, they will pay that out and reduce their cash accordingly. Now we say that bonds mature the same as we do notes payable. Mature means they have reached the full term of their contractual agreement. So a redemption of bonds at maturity would be as such. We have for Candlestick $100,000 of bonds payable. So in order to get that off the books, to reduce our bonds payable, we will debit it $100,000. We will be paying out cash, and when we pay cash out, we credit it for $100,000. Now you're thinking about those discounts and premiums. If they were sold at a discount or a premium through bond amortization, which is not something we'll dig too deeply into at this point in time, there would actually be no discount or premium in those accounts when we reach the maturity date. Now, if we happen to have the situation where we can call our bonds, and we retire those before the maturity date. So it's a 5-year bond, and at year 4, it's callable. We can actually retire it at that point. We would do that because we had the adequate cash flow in order to do it, and it saves us in interest expense from having to pay 1 year's worth of interest on these bonds to the bondholders. When that happens, the company needs to eliminate what we call the carrying value of the bonds at the redemption date. So this is the premium or the discount. It needs to record the cash that's paid. And then we're going to recognize either a gain or a loss on the redemption. Carrying value of bonds is the face value of a bond less any unamortized bond discount or plus any unamortized bond premium on the redemption date. So you would amortize through the redemption date, and then whatever is left over would reflect what the carrying value is. To give you just a quick kind of understanding how that works, let's look at how that would work for Candlestick. They're retiring some bonds that were issued at 103%. They have already paid the annual interest, so that is not a factor here. We're going to assume that the carrying value of the bonds at the date of redemption is $100,400. This is a principal of $100,000. Remember the face value of the bonds. And then they have a premium on bonds payable still currently on the books of $400. First thing they need to do is get rid of their obligation on the bonds payable. So they will debit bonds payable $100,000. They then need to remove the rest of the carrying value. That's the premium on bonds payable of $400. They will debit that, my apologies, $400. Now we have a loss on the bond redemption of $2,600. That is because we are retiring the bonds at 103%. That means that we will pay out 103% to each bondholder. We are paying out cash of $103,000. Now, because we are in a recording, we're not in a live class, I'm not going to make you do this next problem. We'll actually work on it in class. Just go ahead and give it a quick look so that way you know the different things that we will be talking about. Gives you the pertinent information, how many bonds, the date they were issued, what their interest rate is. We're going to look at what would the company receive if the bonds are issued at 95%, what they're going to receive if they're issued at 103%. What would be their accrued interest at their fiscal year end of 12/31? How much interest would be paid on 7/1? The annual interest that is paid on 7/1. And if the bonds are redeemed at 101% on May 1st, giving us some assumptions here on the discount on bonds payable. So here I just want to kind of show you just generally how this would look on your balance sheet. You'll notice that your current liabilities and your long-term liabilities are separated. Bonds payable are showing in the long-term liabilities. The reason that they are representing here is that they are not due in greater than a year. However, in that as we roll into the final portion of that term where they would be due within the next year, you would actually have they would be part of your current maturities of long-term debt or current maturities of bonds payables. As we have talked about with the notes payables, part of it may be current and part of it may be long-term, depending on where you are sitting in that term. We'll see you in class on Tuesday. Have a wonderful day.